Commencement speeches. They are a staple at high schools and universities all around the world. We have successful alumni or perhaps a friend of that particular institute come in and give a speech to the graduating class of that year on how to lead a successful life or a successful business career. And I had a commencement speech at my university when I graduated, and I couldn't for the life of me tell you what they spoke about or who they were. It's just not something that ever stuck with me. But something that really did pique my interest is last night I was reading through Poor Charlie's Almanac and I came across a commencement speech that Charlie did in the late 1980s to his son when he was graduating Harvard School. He gave a commencement speech at that ceremony, and the theme of that speech was how to lead a miserable life. And this is a classic example of Charlie inverting a problem in order to find a solution. Instead of talking about how to lead a happy or successful life, he basically talked about all the things to avoid, all the things that would lead to a miserable life and business career. And it's a speech that was initially inspired by a speech done by Johnny Carson, who was a late night TV show host over in the US, and Charlie took it, ran with it, and added his own twist to it as well. So this video is inspired by that speech. There's plenty of videos on YouTube talking about how to be a good investor, all the things you should be thinking about, all the things you should be doing. I want to instead talk about how to be the worst investor you possibly can in 5 easy steps. So let's get straight into it, and I hope you enjoy. Now, an absolute must do if you want to be as bad an investor as possible and have really, really poor investment returns is to invest very emotionally. You often hear this term of buying low and selling high. When you invest emotionally, you get to do the exact opposite. So what you want to do in order to minimize your investment performance is anytime there is fear around a particular stock that you might already own and the price goes down, particularly if it's just a short-term event, you want to sell that and lock in any losses. Now, this is a guaranteed way to really reduce your investment results, is to really be infected by fear and greed in the market. So anytime a stock goes down, locking in the losses. And if you ever see a stock go up that you don't own and that all your dumb neighbors are making money from, you want to get FOMO. And what you want to do is you want to buy that stock so that you don't miss out on those potential gains that all the people around you are getting. So you want to be very emotional. You want to pay a lot of attention to the short-term hype and the short-term fear and all the news around a particular stock. And that's going to really help you minimize your investment results by overpaying for a lot of businesses that the fundamentals might not necessarily be there for. So rather than focusing on the underlying value or performance of a particular business, investing with your emotions and following these cycles of fear and greed is a surefire way to minimize your investment performance. Now, the second thing you're going to want to do if you want really poor investment results is to have a very short-term focus. Now, this can involve a whole bunch of strategies, but whatever you do, you don't want to focus on long-term returns. You want to focus on getting rich quickly and exercising all of the different levers that you have in order to fail miserably at that. So this might involve things such as options trading, high-risk strategies where there's a lot of potential upside. So you can buy something like a call option, for example. If the stock goes up even just a little bit, you've got a lot of leverage to that and you can make a lot of money. But if the stock doesn't meet a particular price, that options contract can go to zero, and that is a surefire way to take maximum risk in order to lose as much money as possible as quickly as you possibly can. Other options for losing money quickly and having a short-term focus might be other things that would fall into the camp of speculation. This could be anything from betting on earnings of a company and doing some sort of swing trade around an earnings report, maybe hoping that a business is going to come out with good or bad news in the next week or next couple of weeks or next month, and trying to maximize on any news and fluctuations that come out of that. It might be something like betting on stock splits. It might be something like betting on non-productive assets. All of these things are surefire ways to lock in a permanent loss of capital and have really poor investment results over a substantial period of time. The other thing that having a short-term focus does is it really helps you with step number one of being as emotional as possible. Now, anytime that you speculate through these high-risk strategies, that can really get your emotions fuming. You can get super fearful, super greedy, make tons of rash decisions, and it's really, really bad for investment results, which is exactly what we are after. Now, step 3 for poor investment performance is to completely ignore valuation. And if you do want to pay attention to valuation, ideally you want to identify a business and pay way too much for it. Now, you often hear really successful investors talking about the aim of the game being to buy businesses for below their intrinsic value. Maybe you look at the cash flows of the business, you project what you think that company is going to do in the future, you figure out that it's worth 100, and maybe value investors might try and buy it for 50. Now, if we're really trying to have poor investment results, we just want to do the opposite of that. Ideally, if something's worth 100, we want to pay many multiples of 100 for that business. So this might be looking at a company that really has no underlying business. Maybe they're not profitable, maybe they have no road to profitability ever. Ideally, they might not even make any revenue. And this is a really good opportunity for us to overpay for a business and really lock in poor investment results over long term. Now, if you're not interested in doing valuations and overpaying for a business, not doing valuations at all can be equally as effective. It again helps you to get into the mindset of being a short-term speculator rather than a long-term investor. And if you put all those things together, then poor investment results are almost guaranteed. Now, step number 4 to getting poor investment results and really trying to bring those results as low as you can, and ideally even lose money, is to completely ignore what successful investors do. Now, you'll hear many investment channels on YouTube and throughout many finance sort of spaces talk about things like following 13F filings. These allow you to see what good investors are buying and selling. If you really want to minimize your investment performance, ignoring these is a great way to go. So if you see Warren Buffett purchasing into a stock, maybe you saw him purchasing into Apple in 2016 and putting that as his largest investment position, completely ignoring that is a phenomenal way to go. Some people even like to go to the extent of betting against Apple. You know, maybe you go out and short that stock because you see Buffett buying it. Now, even though ignoring these transactions from great investors can be really powerful, something that will be even worse for your investment returns is to focus on never learning a thing from any of them. You know, you often talk about, or you hear from someone like Monish Prabrai, who talks about putting together a list of all the mistakes great investors have made. What I want you to do in order to maximize your investment losses is to not learn anything from that list. So, for example, Monish Prabrai talks about companies often going to zero because they have too much debt, and that being the number one reason why investors lose money. Don't learn anything from that. Ideally, look at that mistake and capitalize on it. So identify companies with a lot of debt, identify companies with a lot of negative cash flow and a high risk of going to zero, and that's a surefire way to lock in as many of these permanent losses as you can, learn absolutely nothing positive from those great investors, and again help you to pull down those investment results and lag the market as much as we can. Now, the fifth and final way to guarantee mediocre investment results is to diversify your portfolio. Now, this is a classic lesson from Peter Lynch, the author of One Up on Wall Street and a fantastic investor, and he talks about diversifying your portfolio as being the exercise of putting other businesses into your portfolio purely for the sake of diversification. Now, if you look at someone like Warren Buffett often talks about putting the most money into his best ideas and not betting on his 10th or 20th best idea as much as he might on his first or second. Now, if you're interested in minimizing your investment performance, you're basically going to want to do the exact opposite. You're going to want to identify a lot of investments that you don't understand particularly well and put just as much money into them as you do your best ideas. Now, if you want to step this up to another level again, what you can also do is look at how Warren Buffett might structure a portfolio with the most money in his best idea, the second most money in his second best idea, and just reverse it. So in other words, you want to put the most money in your worst idea and the least money in your best idea in terms of positive returns. Now, if our focus is negative returns and we want to put a lot of money into our worst idea, that should work out very well for us over a long period of time. So there you have it. Those are my top 5 must-dos if you want to have the worst investment performance possible. Now, in all seriousness, I really hope you enjoyed that video. It was super tricky to film because it feels really unnatural to invert and kind of speak in the opposite of the lessons that I try to talk about all the time. So I do hope you appreciate that and enjoy the video. If you did, I would really appreciate a like. That helps the channel out a lot. If there's any massive investment mistakes you see people making all the time as well, please drop them down in the comments below. I would super appreciate that. But that's all from me today. I hope to see you in the next one. In the meantime, you can watch some older videos over there, hit subscribe over there, and I will see you in the next one. Cheers.